Hi, everyone. This is Jason Bierek of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a returning guest. He has over 40 years of experience in the financial industry. He's the managing partner and founder of Oxbow Advisors. He actually has an amazing story. He grew up very modestly. He overcame poverty, and he became a true success in the financial industry, banking, real estate, many other things. Ted Oakley, thank you for joining me again.
You bet, Jason. Glad to visit with you.
And Ted, you also have 10 best-selling books, and I highly recommend some of them. A lot of interesting stuff there for beginners out there, people looking to turn their personal finances around. And obviously, you've overcome that in the past as well. So I think you have a very motivational story where you overcame a lot, and now you're a success.
Well, thank you.
So we're recording this interview on Thursday, February 15th, 2024. I want to get your thoughts on the stock market right now. Is this like similar to what happened during 1999 and 2000 with the technology bubble? Are you seeing a lot of similarities?
Well, Jason, you are. I mentioned in the letter, we write a letter every quarter, and then first week in January, I said I thought we would make a new high in the markets in the first quarter, just because when you get close like this, they usually make a new high. And one of the things I've noticed here in the last 2 years is that it just gets more narrow. Now you're down, instead of Mag 7, you're down to sort of Mag 5 stocks. And I will tell you that we see a lot of portfolios that come through here from the outside, but overseas, every fund, no matter what the name on it is, they all own the same stocks. So it really, and the individuals own the same stocks, and the mutual funds own the same. So we're high, and most of those companies, even though they've done well, and you can say, well, they have a lot of cash, et cetera. Well, they do, but I think we've discounted a lot of the growth that could even be there for the next 7 or 8 years. Very, very similar to 99, 2000. By the time the first quarter was finished in 2000, I knew for the last 2 years that the markets were too high. I knew they were, but you get frustrated as a money manager because you're wrong for a while. At that time, I was wrong for 2 years. Did it pay off? Yeah. But in the interim, much like we get now, people think that we're sort of perma bears, but we're not. We just realize the markets right now are very expensive relative to what you can get for value. So, we're really defensive right now.
I would also argue that the macro factors are much different and much worse than the 1999 and 2000 technology bubble, because look at the stock market in China. There was an article from the Financial Times interviewing Chinese fund managers and Chinese investors, how they've lost faith in Chinese stocks and Chinese real estate. I think there's also a lot of flight capital that's coming from China here to US stocks, Bitcoin, US assets. And then on top of that, you have the global economy. There's a lot of indicators from Japan, European Union, emerging markets, China, that those countries are already in a severe recession. So it looks like that flight capital is coming to the US too. And on top of that, you have like the passive investing index fund bubble. So people who do have jobs, it looks like that those capital from retirement accounts is going into market cap weighted index funds too.
Well, that's true, Jason. Of course, there's a lot of talk the last year or two about the baby boomers have the most of this. They have the most money in these categories, and they're starting to, instead of put money in, you can expect the next 5 years they'll start to take money out. And so I think that will be one change, and that we'll see. But since everybody is in the very same thing, it's sort of like the Nifty 50 were in 1970. Everybody owns the same things. That means the damage comes in that area, because when you turn and go the other way, everybody has to sell the same thing. And that's when you get a lot of damage percentage-wise in the market.
The anecdotal stories that are happening around me too with Nvidia, the Mag 7 artificial intelligence stocks, QQQ, which is the NASDAQ 100, S&P 500, although most of the stocks, I think 493 out of, or it's even less than that. You said Mag 5 now. So there's a lot of people who over the last many years have no interest in the stock market, but because the stock market has been doing well in the US, at least like the Mag 7 and the S&P 500 and the NASDAQ 100, I'm just getting weird messages from friends, and I didn't know they had any interest in stock market. And all of a sudden, they're trading stock options. They're messaging me that they're trading stock options on Nasdaq 100 and Nvidia and stuff like that. And it's the same thing. I'm single now, and I'm people on the dating apps are telling me how much money they're making on like Nvidia and call options. There's just a lot of very red flag anecdotal stories happening right now.
Well, I could tell you the same thing in late 99. I couldn't tell you how many people told me, well, my son or my boyfriend or my husband or my wife, they've all stopped and they're all day trading now. They quit their jobs. They're going to day trade now. And a year and a half later, none of them are day trading. And so there's a group right now, especially I would say that the 20 to 40-year old group that uh, actually hasn't had much experience of real bad times. And so they just keep on buying them. And yeah, they get profit. I mean, it works that way. And then all of a sudden, when you go the other way, I don't think it will bode very well for them.
Yeah, I agree. And very astute investors. And I think no one has a better track record over the last 30, 40 years than Stanley Druckenmiller. And his filings just came out. He's been taking profits on Nvidia and some of these other Mag 7 tech stocks, artificial intelligence stocks that he was speaking up the last year or two. And he's rotating into cheaper, undervalued companies. So oil companies, gold miners. He's doing cycle rotation. He's profit taking on overvalued companies and rotating assets into cheap, undervalued, hated, discounted cash flow companies.
Well, and that's what you have to do if you run money. Like for example, people will say to us, "You don't own these," but we do. We've owned Microsoft for 15 years. We own a long time. We've owned Google. We own Alphabet. I'm sorry, and Amazon. And so what happens is as they go higher and higher, and you think they're fully priced or overpriced, you cut them back, and you end up so they're not even a full position for us right now. Even though we still own legacy positions, if it was new money, we wouldn't buy them. That's one of the things that happens. But we shifted into, some really cheap consumer staples, and we own some miners too, own the gold outright, and own a lot of gas pipelines, oil pipelines, energy, E&P companies. It's just a cheap area.
Yeah, I agree. Oil and energy and mining companies are looking super cheap right now. So I know in the short term, maybe the commodities prices can go lower. I think there's severe supply side problems. There's definitely severely discounted cash flows on some of these companies. Net asset value discounts on some of these companies. It's over 40%. It's nuts.
Yeah. That's true. And you look at natural gas today, $1.75 an MCF of gas. Yeah, that should be 3.50 or $4, and it will be at some point in time. And it's not like it was before. We're probably coming in where this supply demand look is like 1-1. It's not like 2-1 or 3-1. And when you get in that kind of situation, that means the prices will probably hold.
Yeah, I agree. I mean, at what below $1.70 natural gas, I don't know anyone who can make money now. Some of these companies they did hedge at 3 or 4, so they're doing okay. But when those hedges expire, they're going to be in trouble if natural gas prices stay this low. They're going to have to take a lot of supply offline.
Well, that's true. I mean, the users are liking it, the end users liking it, but the problem about gas is once you're producing, you got to sell it. And so, you end up taking a cheaper price, but there's a lot of gas. And so, eventually I just think we go to higher levels on it.
So I want to ask you about interest rates. In your opinion, what would it take for the Federal Reserve Bank to cut rates? Does something large have to break first?
Jason, I would think something like that. I suppose I don't think any of us can ever tell what this group is going to do because they've made so many errors in the last 25 years that you can bet they'll make some more. But one of the things was looking at though is that let's just say you have a very low unemployment rate right now, which we do have, and all of a sudden, so the Federal Reserve decides we're going to really lower the rates back a lot. If you think about that, all of a sudden that would actually just reinvent another round of inflation because all of a sudden you're going to have to be paying more for employees because we already have unemployment really low. People they can't get good help right now. We can't. And so you look at that and you realize that if they start lowering right now, you almost would create another round of that. Now, I think they will lower, but I think it will be because all of a sudden you look at earnings going down, we get into tougher economic times. But that's, by the way, that's just a guess. But if I were guessing, that's what I would think would happen.
Yeah, or the next shoe to drop is commercial real estate. And we'll talk about that a little bit later in the interview. If there is some type of contagion crisis or insurance companies have problems with their commercial real estate portfolio, I could see the Fed, after some failures or bailouts or liquidity programs, start to cut rates in a panic very, very rapidly.
That's, well, they would. I mean, when pain comes, that's when they start pushing the money out. As soon as you see pain, you'll know that that's what'll happen.
So I know you travel all over the country. You were telling me in past interviews when we weren't recording that you travel a lot. In your opinion, is the real economy in the US, is there a bifurcation going on where people who are making over a couple $100,000 and don't have a lot of high interest debt, say a lot of credit card debt or student loan debt or auto loans, or they locked in a 30-year fix, or they have a variable rate mortgage or high rent? Are those people doing well versus the people that are exposed to, let's say, credit card debt, auto loans? Is there like a severely bifurcated economy now in the US between haves and haves nots with the Fed policy with the rate hikes?
Well, Jason, I certainly think there is, and I guess I have a little better outlook on that than a lot of people on Wall Street because I grew up at that level. I grew up poor, so I can talk to people and figure out what's happening with them. But one of the things I think people should realize is they wonder why this rise of nationalism and isolation and that sort of thing. What you've done is you created this really small group at the top that has a lot of money, and then it's nothing but greed, greed, money, money, and then you really just riddled the middle class and the lower class. And what happens in every society in time, that group says, you know what, we've had enough. And you can see that now a little bit in the voting and what people wonder why we have these extremes. And I go back to this, that, we've been in a society that was all about the upper level rich. And by the way, I'm in that category in terms of national numbers, okay? But on the other side, I think I do as much as anybody to go the other direction too, as far as helping people. But I think that's what's going on right now. And that's why you see all of this pushing that direction, and it will eventually show up in not so great a way. I think eventually, I think that's where we are.
I think we are seeing that in the polling for voting for the issues. I mean, one of the issues that's going to be coming up in the 2024 election, one of the major ones, is not just the economy, but also inflation. So we have the government official inflation data, the consumer price index, saying that inflation is going to be headed below 2%, although there was a hot number recently, but the trend over the last 6 months is still trending downward, except for the recent spike. Do you think that there's going to be continued stagflation, shrinkflation from a lot of these business owners? Because I'm just seeing headlines that politicians are talking about forcing higher minimum wages. There's higher insurance costs. There's all these costs for a business owner that look like they're still trending upwards.
Well, that's true. I think the what people don't realize is they change the numbers on you all the time. If you went back, say 25 or 30 years ago, and you took what went into the CPI at that point and ran it today, it'd probably be 9 to 10%. But see, they run the numbers around all the time and try to keep it looking good. I mean, there's a method in the madness. And I think they do the same thing with employment. There's a lot of things that happen that way. But yeah, I mean, I think inflation's worse than it looks. And if you asked the average person on the street, they'll tell you, hey, look, I'll tell you what I'm spending for groceries today relative to 1 year ago to 2 years ago. One of the housekeepers I have, for example, said, Mr. Oakley, hey, I buy this baby aspirin for you. I take one a day. You're too young for that probably, but but she said that's doubled in price in 30 months, double. And I'm like, see, people notice things like that, but not the ultra wealthy, because they send somebody else to the grocery store or whatever. I mean, they don't think about it. But I'm just saying there's a lot of inflation that people can't see. And I think that's what's holding things back quite a bit.
There's actually a shocking amount of people that have used like groceries and other normal consumer purchases just to survive. They put on buy now, pay later debt credit plans. So that's spiking. But I think we're with interest rates where they are, I think we're going to see a lot of defaults on auto loans and things like that soon.
Well, and you know, and it's just it. I think the necessities for people right now, you know, shelter, clothing, food, you know, transportation, all of that's got them in a point where they're hand to mouth in a lot of ways. And these people that I see that come on the press and say, "Hey, this consumer is in really fantastic shape." I take it from me, somebody who grew up really poor, they're not. So that's the thing about it. You have to really know what's really going on out there.
So I want to transition now to real estate. We'll talk about both commercial real estate and also residential real estate. And I want to give a shout out to you for your excellent interview a couple months ago with Ivy Zellman on your YouTube channel. I actually learned a lot during that interview. Now, the official data from the St. Louis Fed says that the official default rates for delinquency rates for commercial real estate in the United States is only 6% nationwide. I know you do a lot of real estate deals. A lot of deals come across your table. You turn them down, but you've done a lot of real estate investment in your career. Do you agree that that 6% default or delinquency rate is anywhere close to accurate?
Well, it's probably accurate, Jason, but it just got started. That's the problem. You know, if you're just starting a cycle of pain with CRE, which is what I think you're doing, then the 6% will be the floor. You know, you'll go the other way. And I think that's what they probably miss on it. If somebody were to say today, it's all over, it's, the worst is 6%, and commercial real estate is going to come right back in the next 6 months or a year, my first question to them would be, okay, who are you going to put in those buildings? Just tell me, and I'll go with you. But, you know, they can't.
There's just way too many warnings, Ted, that have come out lately. We had the warnings from Janet Yellen last week. We're saying that commercial real estate might be an issue. I mean, that sounds like it's way more serious than she's letting on. We've had three bank CEOs, the Bank of America CEO, Jamie Dimon. Yeah, they've talked about the national debt problems. They're also warning that none of the effects of the higher interest rates, the lag effects, have been priced in. I think a lot of that has to do with real estate. And then the CEO of Cantor Fitzgerald Bank, which is an investment bank a little bit smaller than Goldman Sachs, he said the commercial real estate losses the next 2 years, he estimates 700 billion to a trillion. So I think, like you said, it's just getting started. I think there's games being played here. It reminds me, from speaking to bankers, Ted, about the very similar games to the extended pretend games of residential real estate 2005, 2006, 2007.
Well, I think what they thought is we could, you know, that there used to be an old saying, the oil and gas business, stay alive till 85, which was so bad. That didn't work because they still ruined them after that. Well, it's the same way in real estate. I think they think that if we could have just pressed on for a year or two, these rates would fall right back into where they were and everybody would be okay. And that's really not the case. I mean, they're coming up in periods, and you look at a lot of, I'll take multifamily instead of CRE, but take multifamily, a lot of those are set up on 2-year rolls, and they do a 2-year financing when they build it, another 2 years afterwards, but they're not on long-term financing. And a lot of the commercial, you know, they did on floating rate or a piece of floating and some fixed, but it was short term. And that's the problem. And a lot of it, I'll fault the banks for this. They got into this mode of trying to get business, and they did a lot of this stuff, more than they should have, non-recourse. So if I own a big building, it's not working, I'm just going to hand you the keys. I'm out of here. And that, I think, is going to be one of the big problems for the banks, because they're going to hand them some keys over the next year.
Is that similar to a strategic default in the residential real estate cycle from what, 2007, 8, 9?
Well, the thing about happened in 2008 and 9 was people would just say, well, just foreclose on it, you know, because I can't make the payment, so I'm moving to an apartment or whatever I'm going to do, moving somewhere else, so you can just have it. You know, this is similar, but these numbers are bigger, and I think it will affect you know, the mid-sized banks a lot, and we see more and more banks now that are either not making any money or they're losing a little bit of money. I mean, banks that were in pretty good shape 10 years ago but they got out over their skis. They loaned got too excited about commercial, and there was a lot of fear of missing out on commercial, and we sort of felt like they would overbuild it, and they certainly have.
And bank profits, I think for Q4 2023, I think they were down 45%. And a lot of that is because of the higher rates. I mean, the narrative out there for banking is that when the Fed raises interest rates, an upward sloping yield curve is supposed to be good. Well, if the banks made loans at low interest, or they bought older treasury bonds, I mean, the banks are sitting on some losses here. And I think a lot of it is in commercial real estate.
Well, it is, and it depends on the bank on whether you have floating rate assets or fixed, But if you have fixed, and then all of a sudden, you're having to pay that much more for deposits, all that's coming out of your profit, and that's what's happening now, I think, with most of them. And if you take that and what they have trouble in their bond portfolios, it's a tough business right now.
Now, I remember discussing some of these stories you told me after the recording our last interview about Capital One Bank in the metro areas in Texas. It wasn't an official default or delinquency, but you had the bankers making around phone calls, right, to sell off these office buildings, commercial real estate properties. They were like, "Oh, it's not a default, but we're willing to sell the asset to someone else, private equity or someone else, for pennies on the dollar." So, is a lot of that still happening all over Texas?
Well, I think it's happening all over the country, and not just Texas, but it's happening all over the country where, you know, somebody has a building and they've gone now, they're into it at a certain time and they really can see it's not going to work. Okay. And the bank's gone with them, and the bank's realizing that now too. And they both know it. Okay. But you go far enough into a cycle, and all of a sudden it really explodes. And then when that happens, they blow it up. I remember back in the 80s with RTC, you could buy things for literally 10 cents on the dollar. I don't know that that'll happen this time around, but they're buying them a lot cheaper. I'll have to say that. I'm seeing some things sell for probably 20 cents on the dollar, what you could build it for per foot. So that's kind of where we are.
Wait, are you saying that it's more expensive to build the building from scratch now, so the assets are that deeply discounted that they're selling for below their replacement cost?
Well, if you look at the ones that are have thrown on the market after they've been foreclosed on, yeah, you can buy those cheaper and that's what we see a lot of savvy buyers doing. They're buying things that they couldn't build them for that price. Now, whether they make money on them is another situation, whether they think they can fill it up, but that's just where the market is now.
Did Texas have a lot of I call it a tear down boom because of artificially cheap interest rates starting in 2008, where the developers were able to get all this capital and then they started knocking down one floor strip malls and then building like mixed use buildings with like condos and restaurants and retail on a couple floors? Did a lot of that happen too, where there was a dramatic tear down boom throughout Texas?
Yeah, it did. I mean, what happened is just like you're saying, Jason, you have they just wipe it, and then when they rebuild, they'll have one floor, maybe retail, or two, maybe, and then you'll have residential above that. And there's a lot of that in all the Texas cities now.
Do you think the banks are accurately accounting for losses? Or a lot of these banks like Capital One Bank or larger banks, are they accurately marking to market the losses yet?
I don't think so, because number one, they don't want to, because usually when you look at appraisers, typically, appraisers are hired by the banks, and they work, and the bank will hire them to do an appraisal on something. And I'm not knocking the industry. There's some great appraisers, but I am telling you this. A lot of times they're slow to pick up on what's going on because they don't want to be the first one to say, hey, this thing's just really it's not worth very much, or it's worth half of what it was. And I don't think they want to go out on a limb and do that. But I think that's one of the problems right there.
There was also over the summer, I'm not sure if you saw, there was a Reuters article, I think in June or July 2023, talking about how the legal definition of a default on the mortgages changed. And when I was sending it around to bankers and some of the commercial real estate hedge fund managers that I speak to who are shorting some of this stuff, they were telling me basically like a lot of these lawyers are super highly paid. They don't want to lose their job. So the bankers ordered them to start changing the definition of the mortgage contracts and the lease agreements to what is a default so they can delay things out, because basically like everyone in the industry is delaying this as long as possible so no one loses their jobs immediately.
Well, that's true, Jason. You have to remember, everything in a bank is worded so that the powers that be, the OCC, particularly, and the FDIC, if it's a national bank, state banks do the same thing, but to where it needs to fit between the lines, so to speak. And so the first time you have to call it like it is, a spade is where you basically look at it and and it's bad, and they're going to hand it back to you, and you know what you can sell it for, and now that's where it comes about.
Do you think that if the banks are honest and start marking down the losses, mark to market losses, and there is, let's say, 500 billion or more in losses, and that's not an enormous number. I think that's only about 15-20% of the total size of commercial real estate. If there is 500 billion or more in losses, does that mean the Fed or the FDIC or Fannie Mae or Freddie Mac, they have to start buying up these office buildings or bad paper or commercial real estate mortgage-backed securities? They're going to have to stuff it somewhere.
Well, if it gets really bad, it'll be like the RTC was back in the 80s, where, they will have to get Congress to allocate money, and it will be sort of like a vulture fund, so to speak, and they'll buy them up, to save so everything doesn't get crushed. But, the biggest problem for commercial real estate right now is the sublease market's killing the lease market. The sublease market is probably subleasing it, in some cases 40-50% lower than the lease market. Build out already too. So that's a problem. And as long as that's going out there, then it's going to really be hard for somebody with a new building to say, "Hey, I'm worth so much more money," because they can't prove it up on the rental side.
So is subleasing where like a restaurant or retail company tries to, they can't fully get out a lease agreement, but they found like another tenant to pay a lesser amount of monthly rent?
Well, let's look at it this way. If I have a 5-year lease and I've got 3 floors of a building and business is bad, so I do not want to expand into those 3 floors. I have two choices. I can pay the rent on the lease just like it is, the CAM charges and everything, and I'm out of pocket that much money, or I can sublease it for, let's say, 40% less than what I'm having to pay. So I at least save, see, 60 points. And that's, I think, the way they look at it. Yeah, it's going to cost me, but not near as much as it would cost me if I just make the straight lease payment. And that's why they know they're not going into it. So, hey, we'll just sublease it. Have to.
So for listeners out there, one of the main things about real estate is cash flow, because there's a lot of debt involved for the assets. So cash flow is king. But it looks like they're agreeing that the cash flows that were projected are not going to be anything near what they can get right now. So the industry is dealing with a lot less cash flows. It's going to be a mess at some point.
Well, all the way around too. I mean, we see a lot of multifamily operators where they're either stop the cash flows now, or they decrease the cash flow. And we see more and more of that for sure. And you for sure see it in the office building, because they're not full. So it has to be that way.
Yeah, I actually had a conversation on Twitter with Christopher Whalen. He's the institutional bank analyst, and he covers mortgages and real estate. He hasn't agreed to come on for another interview recently, but he basically said he thinks that ultimately this is going to end in another reconstruction finance bank, and the Fed and the Treasury, FDIC, Fannie or Freddie, there's going to be a bad bank and they're going to stick the stuff in there.
Well, I certainly followed Chris a long time. He's really good, and so I wouldn't be surprised at what he's saying for sure, because he's well versed in that area.
Have you ever done any rezoning? Have you made any investments into rezoning where like an office building was converted into, let's say, luxury condos or something like that? Can it be done quickly and easily? Because I hear a lot of people saying that, oh, no big deal. There's a housing shortage. We're just going to take these office buildings and easily and efficiently convert them into residential apartments or condos, and that'll solve the housing crisis. I see that narrative repeated all the time.
Yeah, you see it, and some people are doing it, Jason, but you have to think about it in a big office building. Most of the water, sewer, and the elevators are all in one silo. So if you have to, because every condo is going to have water and sewer. So you can imagine the expense it would take to try to do that and then get to that point. And I think that's a bit of a pie in the sky. I certainly wouldn't want to do it. And I think some people probably will be able to do it okay, but generally that's a tough way to make a buck right there.
There was a mini documentary on 60 Minutes about a month ago, and they interviewed some of the developers in New York City trying to do this near Wall Street. And they were talking like the capex bills, the cost to rezone this land and turn it from an office building into luxury condos. I mean, it was hundreds of millions of dollars. It was not cheap.
I saw that program, which would be worth watching for anybody who wants to go back and pick it up. And all you have to do is watch it, and you realize how much money potentially is on the line there.
Also, the United States is not Europe, so a lot of people are not in favor of the idea of communal bathrooms. So people are going to want their own bathroom and their own shower
Yeah.
in their own condo or apartment.
Well, that's what I was saying. That's the unfortunate part about an office building. Relative, if you look at most office buildings, the bathrooms, for example, are all the same place on every floor. Okay, the floor may be a little different, but not those. And so, and you have to put your kitchen in a certain spot and that sort of thing when you're in an office building. But when you get into the condo side, you're going to have to make them all right, which sounds like a lot of money to me. I'll put it that way.
Yeah, I agree. For the private sector, it's a lot. So if you're a private real estate investor, I mean, we're not in a zero interest rate policy environment, or the Fed's not handing out free capital right now. So maybe if they did switch that, that would be a project for the Fed to do for the government. Although I'm not in favor of that, but I could see the government deciding, oh, we're going to do this to quote unquote solve the housing crisis because a lot of people can't pay their rent. A lot of politicians are trying to buy votes saying, we're going to get this rent crisis fixed soon.
Well, one of the things people should not be they should be wary of is that the government, if you look back at the history of the government over 150 years, they can do things when they need to do something. They run right over individuals. I mean, if you remember, they confiscated all the gold, made you buy war bonds. I mean, when they get in a hurt, they can do things. So don't rule it out. Excuse me.
Do you think that there's a housing bubble anywhere close to 2007, 2008? Because I have friends in the Dallas Fort Worth area, and they were just telling me how much it is to rent and how expensive it is home ownership. So do you think we're going to see anything close to a housing bubble in the next couple of years, similar to 2007? Or do you think that this cycle, the major problem is commercial real estate, office space, multifamily?
I would say the latter, commercial real estate and some multifamily. The thing about the residential market right now is that let's face it, existing home sales are so low, and the reason they are is because nobody wants to sell it at a price that somebody could afford relative to where the interest rates are. And I think if anything, and if you look at the sales, if you look at real estate sales, they're all affordable homes, 250 to 350, little bitty tracts, that kind of thing, and maybe that's what they're selling, and they buy down the interest rates, and that's how they get into it. But generally, to me, real estate will sort of go back like it was in the 50s, which if you go back and look at the 50s, the real estate only went up a little bit, maybe 1% a year, 1.5%. It was a low number. I may not have exactly, but it wasn't one of those things where your real estate was an investment, that's for sure. It was just a home. And I've got a feeling where prices are right now, if they're not going to come down, that means you're going to have to wait a long time before people can really afford that sort of look. So it just sort of stymies the market for a while.
There's also all these hidden costs that are going up like crazy, input costs that a lot of people aren't talking about yet, with what homeowners insurance, a lot of other insurances for homeowners. And then you have property taxes in a lot of areas that have gone up especially on a percentage basis, up a lot in the last 3 to 5 years. So all these costs for home ownership are up enormously. It's not just that the mortgage prices are higher.
Well, it was a perfect storm because what happened is real estate went way up. So that meant that municipalities and counties and states could tax a lot higher. I mean, they made a windfall for 2 years in a row. I mean, just ask anybody that has taxes anywhere. And then the insurance companies got in on it because what they could do in property casualty is say, well, this value is higher. It's the same building, by the way. Okay. And no change in the building, but they're going to say it's worth a lot more money now. So we need to, we need to raise those prices. So if you look at property casualty and taxes, that is really I think, hurt the individual trying to buy a home.
Yeah, I agree. It's not just mortgages. And then there's a lot of older homes now where the property value of the last couple decades is up enormously, but the home, no one wants to live in it. The home has to be torn down, but the property value is worth so much that here locally, I mean, I walk by it every day, walking my dogs, and there's a old home that was built, I think, in the 50s or 60s post World War II. They just tore it down and they're building a McMansion very quickly. The property value is worth a lot, but the house is going to sell for probably close to $2 million. The old home was worth nothing like that. There's a lot of that going on still, even at rates at these levels.
Yeah. But you're seeing more and more, almost every state, you're seeing more and more listings now. I mean, you're starting to stack it up a bit now. So it'll be interesting to see how it looks by the end of the year.
Do you follow Melody Wright's work? It looks like Texas and Florida are two of the worst, where there's, especially like outside of Miami and some of these planned neighborhood communities, there's like a dramatic overbill, not in the MLS.
Uh, I think who you're talking about, and I'm sorry if I'm not exactly on it, but I saw an interesting interview by her and how she went out in the field and really truly found out what was going on with builders. I think that's the same lady we're talking about.
Yes.
And it was really interesting, and I was impressed with the way she did it too, by the way.
Yeah, it seems that the developers to boost like their sales for their stock price, because it wasn't the home builders index. I haven't checked in the last couple of weeks, but it was at an all-time high despite mortgage rates where they are. But the home builders, they were, playing games. They were buying back what they were giving new homes a discounted mortgage to offload them, to offload the inventory.
Well, and it got back into, okay, I've sold it, but in the contract, I can give it back in 60 days or what. I mean, there's a lot that goes on, but I thought she did a good job of being out in the field.
So do you think that deflation is a long-term risk, or do you think that the people in power, the governments, the central banks, they won't allow deflation?
The problem about the central banks is you can just tell this by looking at them, they don't really know what they're doing. If you look at the last 30 years, everything they've done practically has been bad. And so both sides. But the thing about it that on the deflation side is that if I were guessing, you'd have more inflation. Now you may early on here, just because of where we are in the cycle, you may have rates come down a lot right now. Okay. But I think they'll go back up is the thing. And over time, I think that's where we're headed till we hit the wall, I should say.
Do you think that interest rates stay higher because there's a lack of foreign demand for U.S. Treasuries? Do you think that that's a big part of it?
No, I think well, that's part of it. And yes, they're buying less, but a lot of it is that we keep issuing more and more debt from the government. It's crowding out. So that's a big part of it right there.
But a lot of these central bankers and the PhD economists who advise the politicians, they seem to be very anti-deflation, especially debt deflation, because then that means asset prices fall, tax revenues collapse, and
Yeah.
then governments can't tax it. So that seems to be that they won't allow, maybe they allow deflation, I don't know, for 6 months, but then they're going to pull what some of the same policy stuff in 2008 or what FDR did in the post-October 1929.
Well, Jason, they'll keep doing that until they can't. I fully expect sometime in the next decade, that we will have our debt will get to a point to where people won't buy it, or they'll at least balk at buying it, and then the powers that be have to do something about it. That's they won't do anything until times get really bad. They have to really have something bad go on. But when you get to that point, then they'll be more austere. That's when they can do tough things that they can't do now politically, but they'll have to then. And I think that happens in the next decade.
Yeah, I just see so many problems in the global economy, and yet the US stock market is soaring like crazy. But I think a lot of that's not based on fundamentals. I think it's on flight capital leaving European Union and China, and then people just chasing the price after it's already gone up. It's not fundamental driven.
Oh, no, 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 no. It's all price driven. It's not value driven at all for sure. It's all price.
Well, we live in very interesting times. Unfortunately, I think there's going to be a lot more volatility going forward, although we're not seeing that with the VIX, but we are seeing that with the dollar and bond yields. The 10-year US Treasury yield has been a roller coaster the last 6 to 8 months.
Yeah, it has. I mean, we've kept our durations very, very short, so we haven't had to deal with that a lot. But I wouldn't be surprised at either way in the next 6 months.
Well, we got, I just saw this on Fox Business a couple hours ago, $1 trillion of commercial real estate loans due that need to be either paid off or rolled over in the next 12 months. And there's many trillions more over the next couple of years. So it could get ugly very quickly.
It could. I'll have to say that.
Well, Ted, I really enjoyed our discussion. We'll have to have you back on for more real estate analysis here. I really liked your interviews with Ivy Zellman and others. So please keep up the good work. I'm learning a lot over there from your interviews. If my listeners want to follow the work at Oxbow Advisors, how did they do so?
Well, the best place to do is just come to oxbowadvisors.com. And I'm certainly not a real estate guru at all. I've been around it, my whole life. I've invested in it, done different things. I love real estate. I think it's one of the great investments of this country. But I'm certainly by no means not an expert, and I can just tell you what I see, and that's kind of where it is. But you go to the site, which is oxbowadvisors.com, and most everything is there that we do.
I would say what you see, Ted, is more honest than the MLS data right now. And it's more honest than a lot of the spin coming out of the PhD economists on Wall Street and in DC, because the narrative right now is there may be a commercial real estate crisis, but it could be years away.
Yeah. Well, that's what you want to feel like when you're hoping that rates come back down and you can refinance. But and in the change in remote work, I mean that's the shift. And so people are thinking. I talk to these commercial people, and they'll say, "Oh yeah, they're coming back." And I'm like, I don't think so. Not 100%.
Yeah, it seems that commercial real estate office space is being hit by the perfect storm. So not only do you have remote workers, you also have people buying more online. So retail doesn't need as much expensive space in shopping malls. Retail can just set up what warehouses and sell more online. So all these confluence of factors, higher interest rates. So all these confluence of factors, people moving from an expensive city like New York City to somewhere cheaper, and then getting online work or remote work. So all these factors are confluence here, and it seems that commercial real estate is dealing with a perfect storm right now.
Well, and keep in mind now there'll be some opportunities. You always get opportunities that are they're in a really beaten up sector, and you have to keep your eyes open because that's when you really find the things that'll work at some point in time. And not all commercial real estate's bad. So, they'll try to paint it like that, but you may find individual situations where, you put a pencil to it, who's in it, and all sorts of things, and, this will work. And I think you have to keep that in mind too.
Yeah, I agree. There's a lot of high net worth investors right now that are parking cash in what short term US treasuries, and they're waiting for valuations either on better stocks or other types of real estate investments to come down.
That's for sure. Yes, they are.